Hello, this is Bryan Emmert with WestCobb Alliance, Reece, Nichols. Welcome to Southwest Missouri Joplin Real Estate Channel. Today we have a special guest, Gabby Sandoval with SMB Bank. Tell us a little bit about your business and the history with you lending in the lending business.
Well, I've been in lending for 10 years, but most of my lending experience comes from consumer lending, not real estate. I'm fairly new to real estate lending. I only been doing it for just a little over a year. I work for SouthWest Missouri Bank. SouthWest Missouri Bank is a small community bank. It was established in 1979 in Carthage, and we have 11 locations. We have a couple locations in Neosho. We have locations in Joplin, Carthage. We also have locations in Jasper County, and in Jasper and Oronogo. So the company has been in business for 46 years. It's a great company. I love working for SouthWest Missouri Bank.
Can you explain the different types of commonly used loans for residential homes?
Yeah, so we have the RD loan, we have FHA conventional, and we also have the VA. The RD loan is one of the most common loans because of the area where we live. We're located in an area that qualifies for that loan program. That loan program does 100% financing, so customers that qualify for that, a lot of times they can get in a house and not have to come up with any money. There's been times when the sellers are willing to cover the closing costs, so that, and because the program doesn't require any money down, there's times when customers can move into a new house without having to put any money down. So it is a nice product. The FHA, FHA is also a good product, but for FHA, there's times that we see customers that are buying a house that doesn't qualify for the rural development loan. And for that, the FHA it only requires 3.5% down. And they can buy a house that is not within the areas that qualify for the RD. So if someone is looking for a house in Joplin, they wouldn't qualify for RD. So the next option, if they don't have a lot of cash down, will be FHA. That program only requires 3.5% down. And the closing cost, sometimes, like I said, it's same scenario. Sometimes the sellers are willing to pay the closing cost, so the customer would only require 3.5%. So we have that one. VA, we participate in VA as well. And conventional, conventional is one of my favorite programs for customers that have the cash down. That is a great program. Yes, it is a little more down, but so typically it's 5% down. But for first-time home buyers, sometimes they may qualify with only 3% down to get in conventional, as long as their income is within the medium income, for that location, the geographic location where they're at. So conventional eliminates PMI once the customer meets the 20% down. That PMI, the private mortgage insurance, goes away. So that is it's a good product. That's what I did when I bought my house, and it was nice not to have that PMI once we met the 20% down.
What's the difference between a fixed rate and an adjustable rate mortgage?
The fixed rate is a rate that is locked for the life of the loan. So you can lock it for the 20, 30 years, depending on how long you're financing for. The adjustable rate mortgages, those products, the rate is only locked for a certain period of time, let's say 5 years, 7 years. It depends on what product you do. So that your payment will be changing, at some point. So it's not a guaranteed payment. With the fixed rate, your payment will always be your payment. Yes, and then one thing that I want to mention is that the payment can still change if escrow changes, like insurance and property taxes go up. That will be the only thing that will make the payment go up. But as far as the principal and interest payment, it will always be the same on the fixed rate.
What are closing costs and when are they due?
Closing costs, well, they're due at closing. So closing costs they're the fees, that come with the closing. I mean, buying a loan. So there's origination fee is part of your closing costs. The appraisal, title work, prepaids and insurance and property taxes. The prepaids are. The majority of your closing costs will come from the prepaids. So customers will prepay 12 months in advance. And it also depends on what time of the year you're buying your house. Sometimes it may not be as much, but the prepaids for the 12 months, and on the refinance, it will not be as much. If you're refinancing, it offsets, from the money that you have already prepaid on your previous house. That's for refinancing. But if you're buying a house, we will collect 12 months of insurance, property taxes, origination fee. So there will be some fees, and usually the closing cost will be about 3 to 6% of the purchase price. I will tell you right now, SouthWest Missouri Bank is one of the only banks that I have seen that offers a really low flat fee and origination fee, and it's pretty good.
Can closing costs be rolled into the loan or paid by the seller?
Yes, it can be rolled into the loan. Let's say that the appraisal, the house has enough equity, it can be rolled into the loan. If another way, even if the house doesn't appraise more, another option will be if the seller is willing to come up with the closing costs. So they can do that, and that definitely helps the buyers,
And the loan can be paid by the seller?
Yes. Mm-hmm.
Okay. All right. Well, thank you very much for your time, Gabby. If you have any questions, feel free to put a comment in the YouTube channel, and like and subscribe.
Thank you.